Welcome to the culmination of our series, Demystifying the USALI. We trust that your journey through this framework has shed light on its profound significance for financial and operational managers alike. It has underscored its pivotal role in deciphering the financial landscape of businesses and how it facilitates strategic planning to drive proactive outcomes. In this final presentation, we venture into revenue recording, focusing on scenarios unique to the industry. Additionally, we'll delve into the array of resources at your disposal to address frequently asked questions and enhance your grasp of the USALI framework. Finally, we offer a sneak peek into the upcoming edition of the USALI, teasing captivating topics that await exploration. Our conversation begins with the concept of how we record revenue. Most are straightforward. However, imagine the countless revenue transactions that pulse through a hotel's operations. Have you ever wondered about instances where entities other than the hotel play a role in delivering goods and services to customers? Absolutely. This raises an interesting question. What is the role of the hotel? Is the hotel acting as a principal or an agent in these transactions? Why does this matter, you may ask? Well, it's an important distinction. If the hotel's commitment involves directly providing specified goods or services to customers, it assumes the role of a principal. In this case, revenue is recognized on a gross basis. The hotel exercises control over the goods or services before transferring them to customers. Conversely, when the hotel acts as an agent, it arranges for another entity to provide the goods or services, resulting in revenue recognition on a net basis. This nuanced differentiation can significantly impact how revenue is reported, underscoring the complexities of the hospitality industry's financial landscape. For accounting purposes, if the revenues are to be recognized on a gross basis, the hotel, as the principal, will bill the customer the gross, or full amount, and that full amount will be recorded as revenue. If the accounting for the revenues is to be on a net basis, then, as an agent, the hotel will bill the customer and record a revenue amount based on the net amount retained or received from the arrangement. A hotel should apply the following two steps to evaluate whether it is a principal or an agent in transactions involving more than one party delivering goods or providing services. Step 1. Identify the specified goods or services to be provided to the customer. And Step 2. Assess whether it controls the specified goods or services before they are transferred to the customer. Then how is this determined? The answer is control. The hotel is a principal if it controls the specified good or service before that good or service is transferred to a customer. If a hotel does not control the good or service before it is transferred to the customer, the hotel is an agent in the transaction. What do we mean by control of a product or service? This refers to the hotel's ability to direct the delivery of and obtain substantially all the remaining benefits from the product or service, and its ability to prevent other entities from directing the use of and obtaining the benefits from the product or service. The benefits of the product or service in this context are the potential cash flows that can be obtained directly or indirectly from using, selling, or holding the product or service. Determining whether a hotel gains control over a specified good or service isn't always straightforward. To aid this determination, three indicators of control can be considered, although they shouldn't be seen as a rigid checklist for every scenario. The three control indicators are as follows. First, the hotel is primarily responsible for fulfilling the promise of providing the good or service. Second, the hotel bears inventory risk either before or after the transfer of control to the customer. Third, the hotel has the discretion to set prices for the specified goods or services. Now, let's tackle a common misconception. True or false? When the hotel is a principal, the proper amount of revenue recorded on a gross basis is easily discernible. The answer is false. The hotel might not always know the exact amount, making this determination complex in some cases. This process can become intricate. The hotel might not have transparency into an intermediary's pricing for its goods or services. If uncertainty persists regarding the transaction price, it's best not to include it in the revenue. Therefore, if the hotel acts as a principal and the intermediary's transaction price is unknown, the hotel should record the revenue it expects to receive from the intermediary. The decision to report revenue on a net or gross basis also affects revenue source classification. Gross or net room revenue is recorded in the rooms department, while audio-visual revenue, whether gross or net, continues to reside in the food and beverage department. If gross reporting is chosen, revenues and expenses are separately recorded within an other operated department for all other revenues. If net reporting is deemed appropriate, revenue is netted with expenses and reported under miscellaneous income. With a solid understanding of these determining factors, let's delve into a parking case study encompassing 4 distinct scenarios. Hotels, particularly those in major cities, frequently offer parking as a guest service. There are 4 principal scenarios for structuring parking services. First, there's the hotel-owned and managed parking operation, where the hotel oversees all aspects, from pricing and revenue collection to employee management and operational costs. First off, let's explore a parking setup where the hotel owns and manages the parking operation. Take Hotel A as an example. It handles all aspects of the parking lot, from operations to guest services. In this scenario, Hotel A sets prices, collects revenue, manages parking staff, and covers operational costs. Here, it's evident that Hotel A is primarily responsible for fulfilling the promise of parking services. It also bears inventory risk and holds pricing discretion. As all 3 control indicators align, revenue and expenses are recorded on a gross basis within the parking operating department. Moving on to the second scenario, we encounter the involvement of an outside contractor. In this scenario, Hotel B contracts with Contractor Z to manage parking services for hotel guests. Hotel B owns the parking structure, maintains the facility, and even has price approval rights. Contractor Z charges Hotel B a set fee, which could be a percentage of revenue or a fixed amount, for providing parking services. Upon close examination, Hotel B is primarily responsible for providing parking services, carries inventory risk, and possesses pricing discretion. Just like the first scenario, all 3 control indicators align, leading to revenue and expenses being reported on a gross basis within the parking operating department. Now, let's shift focus to the third scenario involving an outside concessionaire. Here, Hotel C contracts with Company Z to offer parking facilities under a preferred provider arrangement. Company Z owns and operates the parking lot, and Hotel C doesn't influence pricing. Hotel C collects fees from guests and passes the amount set by Company Z to guests, retaining a commission before remitting the collected amount back to Company Z. Hotel C isn't primarily responsible for parking services in this setup. It lacks ownership of the parking lot, inventory risk, and pricing discretion. As a result, revenue is reported on a net basis under miscellaneous income. Lastly, consider the scenario of leasing to an outside concessionaire. Hotel D owns a parking facility leased to Company Z for operation. Company Z, in collaboration with the hotel, establishes prices and handles the parking lot's operation, including employees who wear uniforms like the hotel staff. In this lease scenario, Hotel D isn't mainly responsible for providing parking services, bears no inventory risk, and lacks pricing discretion. Thus, revenue is recorded on a net basis under miscellaneous income. Understanding these scenarios and aligning them with the 3 control indicators provides valuable insights into how revenue is reported, a pivotal aspect in navigating the intricate financial landscape of the hospitality industry. Now, let's dive into the world of surcharges, service charges, and gratuities. These fees play a significant role in financial reporting and must be accurately allocated to the appropriate departments. Surcharges encompass mandatory, non-discretionary fees automatically added to customer accounts for specific services or amenities. Conversely, service charges encompass disclosed non-discretionary fees presented as part of a service. What sets them apart? If the fee is mandatory and labeled as a service charge, it falls under that category. Examples include room service charges or banquet service charges. If the label lacks service charge, it's a surcharge, encompassing fees like resort fees or bag handling fees. Charting these charges to the correct departments is vital. Resort fees are recorded in miscellaneous income, bag handling fees are coded under rooms other, and various service charges, such as banquet service, restaurant service, and room service delivery, are classified under F&B others. Health club/spa others encompass charges like pole towels and spa services. In contrast, we have gratuities, discretionary amounts added by customers for services provided by employees. These gratuities, either received in cash by employees or distributed by the employer, are treated as income for the employee and aren't recorded as revenue for the property. More detailed examples can be found in the USALI book and on HFDP's subscription access for the USALI book. There you will find an interactive section of frequently asked questions and one area specifically related to gross versus net reporting. The insights shared throughout this series, combined with the comprehensive content presented in both this video and its predecessors, have laid a robust foundation for comprehending the intricacies of the USALI 11th edition. HFDP extends an invitation to explore the USALI 11th Theory and Practice courses available through the HFDP Academy to amplify your expertise further. These self-paced online courses immerse you in the depths of the USALI, encompassing diverse modules and practical examples to reinforce your comprehension. As you progress through these courses, you'll cultivate a deeper understanding of financial principles and the ability to apply them. Moreover, an opportunity awaits to enhance your analytical skills through the benchmarking course. This course aids in integrating analysis by utilizing ratios and comparative data sourced from esteemed industry authorities like SDR, Hotstats, CBRE, and HVS. Your journey toward mastery commences by venturing into the wealth of resources available at hftp.org through the HFDP Academy. Embrace the opportunity to refine your understanding and excel in the dynamic world of hospitality finance. As we bring this introductory course to a close, let's take a moment to glimpse into the future. The 12th edition of the USALI is on the horizon, and your solid grasp of the 11th edition will serve as a valuable bridge to smoothly transition and comprehend the upcoming changes expected to take effect in 2025. Among the intriguing additions discussed in the exposure draft for the 12th edition, a new brand and operator cost schedule is on the horizon. A fresh perspective emerges with the introduction of the Energy, Water, and Waste Schedule, addressing environmental impact metrics, which are increasingly sought after by various stakeholders. As the industry evolves, executive lounges, channel mix, and loyalty programs are also being spotlighted in the realm of room operations. Furthermore, the 12th edition aims to provide enhanced clarity in the food and beverage domain, particularly concerning specific sale types, and delves into discussions around sales and marketing expense categories. In closing, your completion of this course marks a significant achievement. You now possess a good introductory understanding of the USALI 11th edition, and you have acquired insights into the intricate financial landscape of the hospitality industry. This knowledge is certain to be an invaluable asset as you navigate your future endeavors. Congratulations on your accomplishment, and well done.